Hello, everyone. Welcome to the weekly lecture videos once again. And in this video, I'm going to discuss the second learning objective of chapter 2. We will learn about accounting income and cash flow. So we start with the statement of profit or loss. The statement of profit or loss is also called income statement. And this statement measures performance over some period of time. It could be a quarter, a half year, or a full year. And the equation for this statement of profit and loss is at the bottom of the slide. You can see revenues minus expenses equals to profit. So if you think of the statement of financial that we discussed in the last video, if you think the statement of financial position as a snapshot, then you can think of a statement of profit and loss as a video recording covering the period between before and after picture. Okay. The first thing reported on a statement of profit and loss would generally be revenues, and expenses from the firm's principal operations. Subsequent part includes, for example, financial expenses as interest paid, taxes paid. The last item is profit from the period, okay, which is also known as the bottom line. Profit for the period is often expressed on a per share basis, which is known as earning per share or EPS. When looking at a statement of profit or loss, the financial manager needs to keep three things in mind. Okay, for example, accounting standards. In Australia, it will be Australian accounting standards, cash versus non-cash items, and time and costs. Okay, so let me briefly discuss each of these points. So first of all, a statement of profit or loss prepared using AAS, Australian Accounting Standard, will show revenue when it accrues. Okay, so this is not necessarily when the cash comes in. The general rule, this is known as the recognition principle. So the general rule is to recognize revenue when the earning process is complete and the value of an exchange of goods and services is known or can be reliably determined. Okay. In practice, this principle usually means that revenue is recognized at the time of sale, not at the time of collection of cash. Okay. Similarly, expenses shown on the statement of profit or loss based on matching principle. The basic idea here is to first determine revenue as described in the recognition principle and then match those revenue with the cost associated with producing them. Okay, so if we manufacture a product and then sell it on credit, the revenue is recognized at the time of sale. Okay, the production or other costs associated with the sale of the product will likewise be recognized at that time. Okay, so the actual cash outflows associated with the production and marketing of the product may have occurred at different times. Okay, so as a result of the way revenues and expenses are reported, the figures shown in the statement of profit and loss may not be all representative of actual cash inflows and outflows, okay, that occur during the particular period. And that's why the accounting income and the cash flow might be different. Now come to non-cash items. A primary reason that accounting profit differs from cash flow is that a statement of profit and loss contains non-cash items. And the most important of these is depreciation. Okay, suppose a firm purchases a non-current asset for $5,000 and pays it cash. Obviously, the firm has a $5,000 cash outflow at the time of purchase. However, instead of deducting this $5,000 as an expense, the accountant might depreciate the asset over a 5-year period. Okay, so in the cash flow statement, it will show $5,000 as a cash outflow, but in the income statement, it might show only a part of that as depreciation. Okay. The depreciation deduction is simply another application of the matching principle. Okay, the revenue associated with an asset would generally occur over some length of time, and the accountant seeks to match the expense of purchasing the asset with the benefits produced from owning that asset. Okay. Then time and costs. It is often useful to think of the future as having two distinct parts, the short run and the long run. These are not precise time periods. The distinction has to do with whether costs are fixed or variable. In the long run, all business costs are variable. Given sufficient time, assets can be sold, debt can be repaid, and so on. If our time horizon is relatively short, however, some costs are effectively fixed, they must be paid no matter what. Okay. Other costs such as wages to staff, payments to supplier are still variable. As a result, even in the short run, the firm can vary its output level by varying expenditures in these areas. The distinction between fixed and variable costs is sometimes important to the financial manager. By the way, costs are reported on the statement of profit or loss is not a good guide as to which costs are which. The reason is that in practice, accountants tend to classify costs either production costs or period costs. Product costs include such things as raw materials, direct labor expenses, and manufacturing overheads. And these are reported on the statement of profit and loss as cost of goods sold. Similarly, period costs are incurred during a particular time period and might be reported as distribution, general, and administrative expense. Once again, some of these period costs may be fixed and others are variable. Earnings management. The way that firms are required by AAS to report financial results is intended to be objective and precise. In reality, there is plenty of wiggle room, and as a result, companies have significant discretion over their reported earnings. For example, companies frequently like to show investors that they have a steadily growing earnings. To do this, they might take steps to overestimate or underestimate earnings at various times to smooth out dips and surges. And doing this is called earning management, which is a controversial practice. With the increasing globalization of business, accounting standards need to be more alike across countries. And in recent years, Australian and New Zealand accounting standards have increasingly become more closely harmonized with international financial reporting standards, IFRS. And in particular, the Australian Accounting Standard Board and the New Zealand Accounting Standard Board have working towards international policies. Okay, so this is the end of our discussion on Learning Objective 2. In the next video, we will talk about the average and marginal tax rates. Thank you very much.